Well, I guess they say it's better late than never. This is the December update coming to you a few days into January here. But with Christmas holidays and everything else, just have been catching up on some work. And so I just finally got around to compiling this. But the data is for the month of December. So we're all on track there. And the next video in this series is going to be a little bit ahead of schedule. It will be 3 weeks from now. In this video, changing things up just a little bit. I'm going to be adding a little bit of additional commentary. I want to sort of go back to the beginning. A lot of people who are watching this video, you never saw the first few videos in this series, which started back in August of 2022. So a lot of the metrics we're covering, the logic behind them might not be clear to you. And I want to go back and use some examples from earlier videos in this series to just sort of explain what the metric is and how you can apply it. Huge bonus here. You're going to be able to see how much I've aged in the last 18 months. So that's a little hidden bonus for you there. Also, I'm going to be changing up the verdicts section a little bit. Typically what I do here is at the end of each metric, I sort of tell you, where I think it's telling me, yes, we've reached the bottom, no, we haven't, etc. For this video, and this video only, I will go back to the normal routine next time, but I want to ask what these numbers are telling you. I'm looking for some feedback on each of these, or you can save your feedback to the end when I recap all 6. But a lot of people have commented over the year and a half or so that some of these metrics might not be valid today, or there may be other ways of looking at them. So that's going to be your opportunity to weigh in there. Remember, the aggregate of these metrics are what is important, not one in and of itself. What we're going back is we're looking at some history, and we're using those to assess as a guide for us. By the way, if you want market updates every weekend, I put out the Pulse newsletter, and you can sign up. I will put a link here. And also, we have podcast versions of all of our YouTube videos as well. So I will put a link there if you want to be able to follow us off without sitting in front of your phone and doing that. So at the last update, if you recall, that was for the month of November. You'll recall that the major markets were still in that Santa Claus rally. They had done quite well leading up to the end of November. Well, when we flipped through to December, we can see it was more of the same. In the month of December, the NASDAQ was up more than 5%. The Dow Jones, about 4%. We can see the S&P 500, the Toronto Stock Exchange. All of these indices that we followed had very good finishes to the year. Let's stretch that line out, and we can see with a one-year number here that, again, all of these indices had strong years. The NASDAQ, of course, leading the way, up more than 50% for the year. But even the laggard, even the TSX was up 8%. And, in a normal year, 8% is considered a reasonable rate of return, or a reasonable return on your money. So that was a pretty good year, 2023, for the equities, which suffered quite a bit through 2022. I want to get into these 6 metrics today, look at what's happening today, and as always, I want to start with metric number 1, which is the yield curve inversion. And first off, there's a quick review. I want to look back here to see what this is, an example from an earlier video. So I'm going to flip back to 2022, August right now. Here we go. We're going to start signal number 1, which is the yield curve. Now, there are a lot of different types of yield curves. One of the most common that we use to measure the economy or where we're at is the 10-2. So the 10-year treasury and the 2-year treasury. And this is what's known as a leading indicator. If we look back over history, this yield curve, or more specifically, when the yield curve inverts, which means that the short-term rates are actually longer or higher than the long-term rates, it has served as a leading indicator to predict future recessions. When we look back, for example, at the credit crisis, so not that long ago, the yield curve itself, which shows here on the orange line, went negative December of 2005. You can see that it sort of treaded water, but mostly in negative territory right through till about mid or so 2007. And you can see that during that entire time, the TSX, which is the blue line here, continued to climb till it peaked out probably sort of late 2007-ish, as you can see by this chart. As is so often the case here, this inverted yield curve that we saw for that quite a long time period, it was a precursor to, of course, the Great Recession. Anytime you see a recession, you're going to see a sharp decline in the major indices, and that is exactly what we saw here. So in this case, I used the Great Financial Crisis as the example. The keys to that segment were that the markets were rising while the yield curve was negative. We saw that. Then the yield curve turned positive. There was a delay. And then, of course, we had the market crash back then. So I guess the question I'm asking you, you have to assess if you're going to be managing your portfolio now, is, was that a one-off thing? Was that typical of what happens? And history would say it probably is. But very curious into what your feedback is there. This chart I'm going to show you here shows more examples of how things look leading up to recessions and the accompanying corrections. Now, if we look at last month, the US 10-year 3-month, that is the blue line, and the 10-year 2-year, that was the orange line, both were still in negative territory. We flip through to the end of December. There's no material change there, particularly in the 10-year 3-month. It has actually gone back further into negative territory. So, if we're looking here to have these come back into positive territory, then historically, that's when we see the markets correct. While we're getting closer and closer to that recession, a lot of people are still feeling that maybe we've dodged a recession this time around. Not quite so sure on that yet. Time will tell. Or a correction. So remember, the curves go positive first, and then the market corrects. So verdict number 1 on the yield curve. What do you think? Please share your thoughts in the comments section below. Now I'm going to move on to the second metric, which is moving averages. The S&P 500, using that as the proxy versus the 200-day exponential moving average. Again here, I just want to take a moment and review a video from an earlier time. Essentially, when the markets are going up, you would expect that the markets themselves would trade above that moving average because it's lagging, and if things are going up, the average is going to eventually catch up with it. Conversely, when we're in a bear market and you're seeing the markets drop, you would see the market that would perform below the 200-day moving average in this example here. I want to start with the first example of going way back to 1999, 2000-ish, with the tech wreck. And if we look at the chart going back all the way back to 1995 or so, we can see the blue line is the S&P 500. The orange line is, in fact, this 200-day moving average of that index. You can see for the majority of that time, with a couple of exceptions, the index trades above the 200-day moving average, and that's what you would expect for it to happen in a bull market. Now, sometime late in 2000, you can see here where that turned, and there was a dip in the index, and in fact, it crossed below that 200-day moving average. Now, this in and of itself doesn't mean that you're going to see a drop. They go up and above all the time, but when you see a sustained move down below, that's when you can be into trouble. When we, in fact, we look at what happened here in 2000, this was the start of a lot of pain yet to come. We see the S&P 500 then remaining below that 200-day average for quite a period of time. We did see consolidation in 2002 going into 2003, and then you can see an inflection point here where the index crosses back above the 200-day moving average. And if that is sustained, as it was here in this case, you now see a period of time where we're now back into a bull market, and you'll expect to see that continue. If we look at the credit crisis as an example, very much the same thing here. You see the index trading above the 200-day moving average, the orange line here, and then you'll see in about 2007, late 2007, you'll see that all change where we have that crossover below, and then of course we have a very strong dip or a very strong downward movement in the S&P 500 in this case. Much like we saw back in the tech wreck, we're going to see a consolidation nearer the bottom. At some point, we see that market bottom, things reverse, and then we get back to a point where we cross over that 200-day moving average, to use this as an example here, and we're back into more comfortable territory. Really important to note here that, at least in my opinion, the 200-day moving average, the crossover above or below, doesn't really mean we're going into either a bear market or a bull market. It certainly doesn't mean we've seen the bottom, but I use that more to confirm. And so it comes a little bit later. We'll see dips above and below all the time, but when you have that sustained move above or below, that's when I can sort of have some confidence that is acting more as a confirmation of the move above or below. So what are the key takeaways here? Well, in the examples we looked at, something that really jumps out at me is in each case there was a sustained move, whether it was above the moving average or below the moving average. It was multiple years, not just months. We're going to see in a moment here that we're seeing some of that, but in a category of months right now. But in these cases, it was multiple years, from 1995 to 2000, from mid-2002 to mid-2007. Certainly not 100% that this is a guaranteed way of knowing if we're in a bull or a bear market, but it can confirm or form part of that bigger puzzle. Now let's go to the last update that we did here. The SPX, the S&P 500 is the blue line. It had broken back up above that moving average, and the question I asked back then was, will that be sustained? Well, when we look at it now, we can see that it is full steam ahead. Question, as always, is can it last? It takes a few months, a number of months to confirm. Ultimately, it would take probably years to confirm, but at least this is what the information we have to deal with now. Now, I want to have a quick look at a 5-year number, just to give you a little bit more perspective. Again, when we look back over 5 years, we can see a very definitive on the upside, on the downside where that blue line is trading either above or below. If we look at it in the last year or so, it's been a little less definitive. So the market's probably trying to find its way there. So if we get to the results here, if I'm looking at this moving average, in your opinion, is this something that you believe is still valid? Do you believe that it's an indication that we're now in a bull market, a bear market, or just somewhere in between? Maybe sort of that maybe that I often throw out in this series here. Indicator number 3, the volatility index, the VIX, and this measures market uncertainty. Now here is a look back at what I had to say in the VIX in 2022. And if the VIX is running at a high number, it's often the precursor to what we would call capitulation, or the markets are, you'll see when the markets are dropping, the VIX will spike up. And the markets at some point have to get to the bottom, and it often coincides with the higher the uncertainty, the higher the fear, the closer we are to the bottom. Now the average for this VIX indicator is about 20 over the long term. And if we look here at the credit crisis, so we're going back again to that 2007, 2008, 2009 time period, you can see a clear spike up in the VIX, and that corresponds with, of course, a sharp drop in the S&P 500. It also coincides when we see that VIX peak. It also coincides, or is very, very close to the bottom of that as well. Now, if we look forward a number of years, and we're now looking at the COVID crisis, we see the VIX spike up in March 2020 when nobody knew what was happening. We saw the markets take the corresponding crash down in March of 2020. Well, then once that VIX hit the peak and turned, just again, like we saw in the previous example, we see the market then started to go up, and we've had a very strong recovery since then. So as always, we're going to take history, use it as a guide, and apply it today. Okay, so what did we see from those examples there? Well, we saw that the VIX spiked before the market bottom, or almost simultaneous with that. We certainly saw that in 2020. Now, when we look back since then, we can see that we have had no major spike. That orange line is the VIX. We've seen, in general, the blue line going up. That's the S&P 500. Of course, we did see that pullback in 2022, but we haven't seen that big spike out of that normal range. Now, last month, we saw that the VIX had moved down, and in December, nothing changed there. It's steady, traveling sort of along that 12, 13 range. So, there's certainly nothing really jumping out at me, I would say, either way. Now, I want to add a little bit of commentary on this VIX indicator, because there is a lot of talk out there today that the VIX is no longer a relevant metric. That relates to what are called 0 day to expiration options. So literally today, you can go out and buy an option that expires that same day. And the argument goes that that skewed things. And so this the VIX, which uses a 30-day projection out, is no longer valid. So for those of you who may have traded or are up to speed on that, these 0 DTE options, have they changed things? Have they rendered the VIX irrelevant? What are your thoughts on that? Now I'll ask you to weigh in. Is the VIX relevant or not? What is it telling you? The fourth metric is U.S. jobless claims. And like before, I want to go back and review a previous video to see what should happen. When that new application, this is the key to this metric, when the new applications falls for the first time since the bear market, that is a sign that we may be through the worst of it, that we may have seen or be close to seeing the bottom of the market. And again, I'm going to go back to the credit crisis because this is such a great period for studying these types of things. If we look back to 2008, we can see clearly the orange line spiking up as we went into that Great Recession. And almost exactly the same time when that number peaked out, when that metric peaked out, we see a corresponding bottom to the markets back in 2008. A very, very vivid example here of how that number can be somewhat of an indicator, and again, combined with a number of others, might be giving us a clue. Okay, so that's a pretty clear example there of how we should see that jobless claims move when we've reached the bottom and we see that sharp decline in the jobless claims. We're going to focus on initial claims here today, and previously we had seen in a past video that metric coming in a bit of a range there. Certainly no major moves up or down. When we look at it today, end of December, it's back up a little bit. So we're seeing no great move down, which is kind of what we want to see. Now, I want to move this back out since the beginning of 2022 because that's when the most recent correction occurred. When we look there, we do see right at the beginning of 2022, the first couple of months, we do see that drop. And maybe that's your interpretation of it's done. Maybe that is the drop we're looking to see. I would have expected something a little more sustained than that, and we can see by the chart here that things have moved pretty much in a sideways range since then. I'm also looking a little more at the 4-week moving average as well, and we can see on the most recent U.S. Department of Labor news release, the 4-week moving average was 212,000, a decrease of 250 from the previous week's revised average, and we can see that in a chart form here. So does this tell you anything? I've got my thoughts on how to interpret this as I give them, pretty much every month, but we're making a little bit of an exception this month and giving you the opportunity to weigh in. What do you think? What do you make of the data for the jobs market, the unemployment rate, how that all factors in? I'll ask you to leave your comment below. Now, the fifth metric, the Baltic Dry Index. Let's look back at a video I did back in 2022, I believe it was, and looking for an explanation of how it works and an example. And this measures the global demand for raw materials, for commodities, things that you would use when you're building the economy. And simply put, if the economy is growing, you would expect more use for these raw materials, for these commodities. So you're going to see that BDI number increasing. When the market is in a bear market or we're in a recession, you see the opposite. You would see that BDI number coming down. Now, the key to the BDI, to interpreting it, is that the BDI goes up before the market bottoms out. So you'll see that number going up before the market bottoms out. So there's a bit of a lag there. When we look at the credit crisis again as the example, the orange line here is that BDI. We can see that that was dropping along with, with the recession. Of course, there's going to be less demand of these materials. So we see that corresponding drop there. Late 2008 again, this indicator dropped there to the bottom, or it bottomed out, and then we saw it recovering right around the end of 2008. Now, of course, we know that in March of 2009, the S&P 500 and most major other indices also did bottom out, and we see a lag of a few months, but we see that correlation between the bottoming of that BDI indicator and the bottoming of the markets. So that's a pretty good example there of how we would expect the shipping demand to track the economy, hence the markets, and also how we saw the BDI start to move up in a material way slightly before that market bottomed out. So there's more of a correlation that we've seen there. Now, at the last update, we had seen a pretty strong move up. Generally, that's considered to be a good signal. That's kind of what we're looking for if we use that last video as an example. However, since then, again, we've seen a bit of a pullback. Now, the BDI is one of those other metrics that some people will weigh in and say it's no longer valid. And the argument here is that, especially coming out of COVID, especially with the restructuring of the supply chain, things like onshoring, things like nearshoring, where you're creating products closer to where you are as opposed to overseas necessarily, that is rendering the BDI less, either irrelevant or less important. Do you feel that this is still a useful indicator? Again, I can share my feelings on it, but products do ship around the world. I think that there is some validity to it there, but what do these charts tell you? I'm curious to hear that. And then we'll move on to our sixth and final metric for this video. It's called the PMI, the Purchasing Managers Index. Let's review that in this video. Put up by the Institute for Supply Management. And if we use this chart to sort of demonstrate how this metric works, the red dotted line across the middle of the chart is 50, and that would indicate equilibrium, where the manufacturing segment of the economy isn't expanding, nor is it contracting. Now, if we see that line, in this case, it's the blue line trading above that red line, that means that the economy, the manufacturing sector of the economy is in fact increasing. If we see it trade below that red line, that means that it is contracting. And it means the starkest example here is when COVID hit, we can see that sharp spike down where we saw everything practically across the board decline or contract. If that number is dropping, and in fact, it was briefly below 50 before it was revised back up to 50.2, if the economy is contracting, if we're in a recession, we're not going to see stock markets growing. We're going to see quite the opposite. That's just the way it works. Stock markets are forward-looking, and so we want to see positive future in this manufacturing. So the concept there is pretty simple, right? 50 plus is the manufacturing sector is growing, expanding. 50 or below, it is shrinking. And my logic tells me if the sector is shrinking, if the manufacturing output is shrinking, the economy is going to slow. Now, the latest numbers are in for December. In the last video, that PMI was 46.7. When we look at it today, it has risen to 47.4. The Institute for Supply Management website, they say the U.S. manufacturing sector contracted in December as the manufacturing PMI registered 47.4% in December, up 0.7 percentage points as compared to November's reading of 46.7. And just to clarify on that, the PMI came in at a higher level, but that doesn't mean the economy is expanding. It doesn't mean the manufacturing sector is expanding. It means it is contracting at a slower rate than it was in the previous month. So we can see that on this chart here. We can see that recent improvement. This is now the 14th month of contraction. We can see that on the Institute's commentary there. I'll zoom out on this chart here a little bit so we can see 14 months most recently that have actually been in contraction. So the past few months on this metric here, I've been basically saying my opinion is that the markets may be sort of pulling a fast one on us here, not reflecting reality. Thought there may be a little bit too much focus on the NASDAQ, on optimism. What do you think though? Does the shrinking manufacturing sector, that's what we're looking here, does it even matter in 2024, or are we just going to say the heck with that? We're going to ignore that and move on. So this is the point of the video, typically where I go through the summary and I give you my amalgamation of those six metrics and sort of give you an overall feel where I'm feeling. But as I said at the beginning, I'm going to sit this one out. This is your opportunity to share with the viewing audience here what you feel. What camp are you in? Do you believe that we've maybe just sort of skipped the recession altogether and we're now in a bull market, or do you believe that we have some more rough waters to come and there may be some downside yet to come in this? The 6 metrics, just a review. We have the inverted yield curve. We have the 200-day moving average. We have the VIX, the U.S. jobs, the Baltic Dry Index, and the PMI. In the next video, I will get back to giving my scorecard there. Hopefully I'll see you back for that. As always, don't rely solely on this information to manage your portfolio. This is one piece of a very, very big puzzle that we have to work with there. I have a news segment, the trending news that I put out every Monday and Wednesday. I would encourage you to subscribe here so you can follow that. And also we have our Pulse newsletter that goes out on the weekends for those of you who want to keep touch there. As always, thank you so much for taking the time to watch this video, and I look forward to seeing you next month.